This is going to be quite the change in subject from last week's video that was about self-publishing. In this one, we're going to jump to the subject of debt, and that is primarily, well, how do you get less of it? Now, I filmed a full 3-hour video on the history of debt, the whole context of debt and how to approach debt, good debt versus bad debt, just the whole domain of, hey, you owe someone money. What do you do about it? Should you do it? When should you do it? That's not what we're doing today. If you want to see that video, you can click right up here. Instead, in the next few minutes, I want to just cover primarily the 3 approaches that you should take when you have a lot of debt, the 3 ways basically to pay off that debt and get less debt. In addition to that, we'll cover a few of the general things you can do right now beyond just, those frameworks and approaches and strategies, and then basically a secret sauce strategy to just cut a lot of the debt right now down that you owe. I have no course, no nothing to sell you, and again, if you do want to see the basically expanded version of this video, you can click right here. So the subject today is going to be, once again, debt, and I'm going to assume a few things about you. First is that 1, you have a lot of debt, 2, you're relatively young or you don't have a very high income, so in some form you are struggling to pay off that debt, and then 3, you came to this video, you clicked on it, you're wondering, hey, what do I do about it? The general, core focal point that I want to impart first off is that there is no secret sauce when it comes to, getting rid of a bunch of debt. The only secret sauce is bankruptcy, right? Which is, hey, next week you're not going to have any of the debt that you have now. So I want to start there, kind of start at the end. The problem with bankruptcy comes down to your credit score, and we covered this in a different video, but your credit score is basically your trust score when it comes to banks, the government, other people deciding how much they trust you and whether they should trust you with a certain amount of money. So if you have, say, an 800 credit score and 850 is the max on the popular scale, then you're going to get super low interest rates. You're going to basically have infinite money that people give you to do whatever you want with. Now, if that 800 is, say, a 500 flat, no one's going to give you any money, and if you want to borrow money from people in the future, well, you're going to be screwed from day one just because of that little number. Now, the problem with declaring bankruptcy is that no one's going to lend you any money for 5, 10 plus years, right? You're going to have a super hard time just finding money to do anything. And the problem with that is that debt is not inherently bad, right? If you came to this video, maybe you have a lot of debt for something that wasn't worth it, but there's an equally good chance that you have debt from school, which is a comparatively valid use for it. You have maybe debt from, flying to visit a sick family member, or buying a mortgage on a house. Things turn south, maybe you lose your job and you still have that, mortgage on the house. So debt is not inherently bad. Declaring bankruptcy, so the easy way out there is just going to essentially screw you over from doing any of the good things that you can do from and or with debt in the future. So that is not the solution off the bat. It is an option, it is a way out, but you really, really have to have just no way of paying off the debt possibly before you consider bankruptcy. Now, I want to stop here for 1 second in that debt can be crippling financially. It also 1000% can be crippling emotionally. And if you're struggling, I suggest that you consider therapy with the sponsor of today's video, which is BetterHelp. Online therapy is a safe space to talk and receive guided help from a trained mental health professional. And this doesn't just make you feel better, but also is a portal to personal growth that helps you better understand yourself, overall just develop healthier habits and also learn effective ways to cope with, and solve problems like debt. You do not have to be depressed or have anxiety to go to therapy. It's just generally beneficial across the board. And options like BetterHelp you can do from the comfort of your home, and BetterHelp is very affordable. In fact, they've completed nearly 400 million sessions of online therapy for around 5 million customers. That's like, 1.5% of the entire United States. You can go to betterhelp.com/JohnLaw to get a discount on your first month of online therapy. And with that said, let's get into number 3. So the alternatives, like I said, are not a done for you type of thing. There is no secret algorithm there. All it comes down to is, hey, you need money to pay off that debt, and B, how do you go about paying off that debt? So that's what we're primarily going to cover today. Specifically just what are the best approaches in the short run, in the long run, to pay that off as quickly as possible. And hey, ideally, if you can keep up with minimal payments, right, then your credit score stays high. And if you want to get future debt for valid, economic reasons, like say getting a house or whatnot, or maybe starting a relatively low risk business, then you can do so. And also having a high credit score makes it a lot harder to actually go into very serious debt for the reason I'll describe now. And this is actually the first subject and the first debt kind of strategy that I want to cover. So let's say you, have a, not even 750, let's go 820 credit score. So you've been paying back your credit on time perfectly for 15 years, and a lot of it at that. And you have one, say, line of credit that you can't pay down, that's a 20% interest rate, and let's say $150,000. Well, if you have an 820 credit score, what you can do is go to another lender who, based on your credit history, is going to give you, say, $150,000 at a 3% interest rate. And then you take the 150K, you pay down this 150K, and now instead of paying 20% a year, so that's 20%, 30 grand a month, that's roughly $2,500 per month there. That $2,500 per month suddenly becomes 3% of 150, which, just quick math here is going to be like $4,500 a year. Divide that by 12, you're talking, $400 or so per month, right? So immediately, if you have good credit, you're going to get your credit score down, your monthly payments down on this debt from $2,500 to $400. That's an 80+% reduction there. Now, you probably can't do this if you have a lot of debt, but the concept here is using other debt to kind of quote unquote refinance your current debt. So what that means is, and I want to touch on this as well, is first just write down and kind of index the debt that you have. So let's say, for example, you have 3 sources of debt, right? You have student loans over here, you have your credit score over here, and let's say you have your mortgage over here. And let's say, for example, your credit score is 25% interest rates, so roughly 2% per month. Student loans, 14%, and your mortgage is, let's say 8%. So these are the 3 kinds of debt that you have. Well, what you want to do in the concept of refinancing is looking for other sources of debt that you can use that are cheaper than your current debt. And that breaks down into the 2 principal kind of aspects of debt, which is the principal amount, not to reuse the term there, and then the interest rate, right? So we have the principal, and then we have the interest rate, right? So if you owe $100,000, $100,000 is your principal, and then if you're paying 20% a year on that debt, 20% is your interest rate. Now, the real killer when it comes to debt is not even the principal, it's the interest rate. And that's the problem a lot of people are dealing with now when it comes to especially student loans, but also things like credit card debt, right? Is that they're paying, say, the monthly minimums, if that, so then the principal isn't going down, or the principal's even going up, and then just paying down the interest, it's what's killing them. And you obviously know this if you're in a similar situation. So in this case, let's say that you have D over here, and D debt source is a credit line. And if you open a credit line with, let's say, this bank, and maybe they'll give it to you, maybe they won't, you can get a 10% interest rate annually on that debt. So if you're in this situation, what you can do is, hey, look at this 25%, and let's say the interest rate's 25%, let's say the principal amount is, $20,000 on that. You want to go over here, you want to get $20,000, pay down the $20,000 on B, on this credit, card debt, and then now instead of paying 25% a year, you're paying 10% a year, right? So 25% of 20 is $5,000 a year. That comes down to 10%, which is $2,000 a year. So you can cut your monthly payments by a few $100 there. So that's the concept of debt refinancing. In your situation, that's just looking at, hey, here are all the possible ways I can get other forms of debt or borrow money. Well, what are the interest rates on those, and how do they stack up to the interest rates on my current debt? And if there's any overlap there, so if you can go and get debt at an interest rate that is cheaper from a legitimate source, right? Then any of the current debt that you have, well, that's when you want to go and refinance there. Now, the other kind of implicit strategy here is just pay down the highest interest rate debt first, right? So let's say your student loans are $4,000. This is $20,000, and then you have $200,000 out on a house. Even if the student loans are at $4,000, and you feel like, hey, I can pay this down, I can just get it off my chest because I'm not, paying for this anymore. The real killer here is the 25%, the really high interest on the credit card. So that's what you want to pay down first. So 2 strategies thus far, right? Refinance, so look for other sources of debt and use that to cover your current debt or kind of close out your, say, credit lines or your loans. And then number 2, just pay down the high interest rate debt first. Okay, so the third approach here relates to, hey, what should you pay down first? So let's say you've exhausted all the options when it comes down to refinancing. So going to that external, potentially new source of debt or credit, and then taking that money to pay down or completely, or just part of it, right, the current debt that you're dealing with. If that's not an option for you, then it's a question of, well, how do you use the money that you currently have to pay down this debt that you're dealing with? I'm also going to assume that you can't just, pick up some more shifts, get another job, and then put that extra money toward, paying down your current debt, and also make sure that money, the new, extra income that's coming in, does significantly impact, the current debt that you're dealing with. So the best approach here is to look at all the ways in which you're paying debt or the different kind of credit lines that you have out there, and then find the one with the highest interest rate, and then pay the minimums, the monthly minimums on all other debt sources than that one, and then put all the extra money you can toward that highest interest rate, in this case, source B, so the credit card type of debt that you're dealing with, right? So, for example, in this situation, just to back up, again, we have student loans or debt over here, we have a mortgage here, and we have credit card debt here. Let's say your monthly mortgage is $1,200. Your student loan or your student debt's minimums are $600 a month, and for credit card, it's, let's say, $200 a month, right? So even though you're paying $600 a month here, $1,200 here, $200 here as minimums, this doesn't mean you should just put, say, $1,000 into this, $1,400 into this, $400 into this a month, if that's the amount you can put toward your debt, but rather pay this $600, pay this $1,200, and put everything else you can into the $200. And then once you have paid down fully this 25% on the $20K, right? So let's say we fully pay off the credit card debt, then you switch over into, well, here are my other 2 sources. I pay 8% interest on this source of debt, 14% over here. We'll now just pay the $1,200 here, but don't pay $600, pay $1,500 a month if you can, right? And then you take that amount of money, you fully pay this down, and then you shift into that last source of debt. And if it is truly impossible for you to work hard, and if it's truly impossible for you to pick up extra jobs or just work all that you can, make as much money as you can, and put all of that toward your debt, and you're just saying, hey, I still can't even pay down the interest, only then is when you consider bankruptcy. And again, bankruptcy is a valid option. It just kills your credit score because really, really bad. And then finally, just negotiate, right? A lot of people have a lot of debt in the US. We're talking trillions and trillions of dollars on all kinds of debt, whether that's, student loan debt, your mortgages, credit card debt, gambling debt, just whatever that may be. And what that means is the companies that you owe money to, the people, whatever that may be, are likely very used to people being in your exact situation. And what that means in turn is, well, just talk to them. And maybe they have some sort of approach, whether that's, a lump sum payment up front or a, payment plan that just gets your monthly payments down, or a deferment plan, whatever it may be, just talk to them, try and negotiate terms, and they'll be lenient, more often than when they won't be, to some extent, right? That's not saying they're just going to be like, hey, you're off the hook, but maybe you can negotiate that interest rate down a few percent, just defer payments by 6 months, whatever it can be, to just give you a little bit of breathing air that you need to just pay down what is the highest interest rate and then get on to the next source of debt. Now, overall, there is this kind of sunk cost fallacy when it comes to debt, where it feels like if you're just, above water, or you feel like you're drowning, metaphorically, so to speak, in debt, you feel the need to go and do crazier things or riskier things to try and just get back to where you were, right? So that's where you see a lot of like gambling, very high risk investing, taking out more debt to go and say do, day trading or buying crypto or whatever that may be. The general approach that you have to take, and I say this with emphasis, you have to take this with anything finance related, much less debt, is that it is inherently emotional, but the way you get out of it, right, is with logic, it's with reason, right? Finance is inherently a numeric game, it's an algorithm. So the way you win that game is similarly by breaking it down, by making a plan, by doing what you can so that the numbers work, not so that you feel like the numbers work, or not so that you feel like, hey, maybe I have a shot of just getting back to where I was. I get it. There's such a deep, emotional relationship we all have there with money, with our standard of living, with how other people perceive us. But in a lot of ways, again, you're playing the wrong game there when it comes to finance, personal finance, and debt. That is the video for today, and I will see you in the next one.